The maximum you are delaying, that many days you are using that money in some other use. So always you should, for example, in Apple's case, 90 days or 90 plus days are the payables payment period. The payable days are more than 90 days. That means Apple is paying more than 90 days to its suppliers, but it is collecting from its customers maybe within 30 days. So this is the kind of skill it is using. So everyone cannot do that. If you don't have a good reputation, in two situations you can delay your payables. Either you have a very good bargaining power and you are doing that and you are paying late, or you don't have money so you are not paying by default. The first one is a good one because you are having the bargaining power and you are using it. For having the bargaining power, your reputation must be very good. Second one, you don't have money, you are not paying by default. That means supplier will give you the least priority. He will not supply you right in time. He will not give you the best discount possible. He will not give you priority when urgency is there. All these problems will arise for the second condition. You are delaying because you don't have money. Your supplier knows you very well. If you are not paying because of by default you are having credit crunch, you are not having money, you are not having sufficient funding, so you are not paying. That is not a good condition. The first one, you have a good bargaining power and you are using it, that's a good thing. Let us see how it, say for example, here what we said, delaying will definitely you are using the cash in some other purpose. How? Let us see. The route company has an average accounts payable balance of 250,000. So normally your accounts payable balance is 250,000. Average daily cost of goods sold is 14,000. That means you can calculate here payables days, days in payables. How? Payables, average balance in payables divided by daily cost of goods sold will give you the days in payables. And your receivable you get the term from your supplier 215 net 40 from your suppliers or from its suppliers. So Raud is getting credit term of 215 net 40. What does it mean? Either Raud can pay on the 15th day, get 2% discount, or if due to any reason it fails to pay on 15th day, it must pay on the 40th day, no before, no after. Because 40th day is the maximum credit period, it should use it and pay on the 40th day. Pay either on 15th day or on the 40th day. If you are paying on 15th day, you are getting 2% cash discount. If you are paying after 15 but 40th day, then you are not getting the discount. Now what Rod is doing, let us see. How can you do that? First of all, calculate the days in payables. Days in payables is equal to 250,000, the payables, divided by daily cost of goods sold, 14,000, given in the question. 17.9 days. That means you on an average you are paying your suppliers on the 18th day. 17.9 means 18th day. So on an average you are paying your suppliers on 18th day. Is it a good policy? Certainly not. Why? Because if you pay on 15th day just 2.9 days before, just 3 days before if you pay, you get a lucrative 2% cash discount. You are not doing that. You are paying on 17.9 days, why not you pay on the 15th day? Because you pay on 17.9 days, you are not getting any discount. Pay on 15th day, get 2% discount. Number one. Because you cannot use, you cannot pay due to any reason, compulsory reasons. Okay. If you have not paid on 15th day, why you are paying on 17.9 days? Pay on the 40th day. Use the money. You can use the money for 25 days. you're not using. So either you pay on the 15th day or you pay on the 40th day. Don't pay on in between 17.9 days. It is not at all a good credit policy. So the company is losing money for 22 days. 40 minus 17.9, approximately 18 days. So the company is not using the money for 22 days. It could have used. So this is the way we see the credit policy of a company. You can do this at home. The payable is given, cost of goods sold per day is given, so you can calculate the payable days. That is equal to 300,000 divided by 15,000. That is equal to 20 days. Now the company is the policy is 215 net 35. So is the policy good? It's not, because if it pays on 15th day, it will get this 2% discount. It's not paying on 15th day. It is paying on the 20th day. If you are not paying on 15th day because of any reason, don't pay up to 35 days. Use the money. So it is not using the money 35 minus 20. It is losing the money for 15 days, which is not a good policy. For example, stretching accounts payable. Due to any reason you can't pay your accounts payable right in time, then you have the option of cash on delivery. When the delivery will be given, you will pay the cash. Cash before delivery, nowadays we make all credit card payments, right? Either COD or CBD we use. Either we pay when the Amazon parcel comes to us, reaches our place, we pay the money, cash on delivery. Or we pay on the card before we get the product, and the product comes within a day or two, cash before delivery. Now we will calculate what one question is there for delaying the payment. How the delaying the payment will be costing the organization. See here. What is the effective annual cost of credit terms of 115 net 40? That means if you are paying on the 15th day, getting 1% discount. If you are not paying on the 15th day, pay on the 40th day. That is the credit term. You are not paying on the 40th day, you are stretching on the 60th day. We saw in the aging schedule, right? Certain customers always pay after the due period. So you are paying on the 60 days. So open the spreadsheet, please. Go to the 19.3, 19.7, this example. You see, the first example is discussed here. 115 net 40. 115 net 40. That means what? Either pay on 15th day, get 1% discount, or pay on the 40th day. But the customer is not paying on 40th day, he is paying on he stretches to 60 days period. What happens? So, if he pays on the 15th day, he gets $1 discount. The interest rate will be 1 divided by 1999 is equal to 1.0101. Now, he is paying on the 60th day. That means number of days credit period he is getting after the discount period is 60 minus 15 is equal to 45 days. So, in a year, how many 45 days are there? 365 divided by 45 days is equal to 8.11. So what is the effective annual rate here? 1 plus 1.0101 to the power 8.1111 minus 1 will be 8.49%. So if you are paying within 45 days, then your number of the rate was 15.88%. Same if you are stretching to 60 days, see your cost of capital reduced. The effective annual rate if you are paying on 45 days is 15%. The same effective annual rate if you are paying on 60 days is 8.49%. Same, the next question also I have stretched to 60 days. And I just extended the example. 210 net 40. That means 10 days you pay, get 2% discount, or else pay in 40 days. You are not paying on the 40th day, you are paying on the 60th day. What will happen to you? Same, your cost of capital, your interest rate is 2 divided by 98 is equal to 2.0408. Now you are paying on the 60th day. Means credit period you are getting is 60 minus 10. 10 is the discount period. 60 minus 10 is equal to 50 days. How many 50 days in a 365 year? 7.350 days. So frequency. So the effective annual rate will be 1 plus 2.0408 to the power 7.3 minus 1 is equal to 15.89. You see, if you are paying on 40th day, the cost of capital was 27.86. The same if you are stretching to 60 days, reduce to 15.89. So you can always check whether you can stretch the payment to some more days without tarnishing your reputation. So it is being calculated here in the spreadsheet. We have already done it. Homework for you for the next question. Already we have done it. Now we will discuss the inventory management. So hopefully there is no question. I can move to inventory management. So inventory management means holding the right amount of inventory, no more, no less. Benefits of holding inventory is inventory helps in minimizing the risk that farm will not be able to obtain an input it needs for production and helps avoid stock out cost. If you don't have raw material, you cannot manufacture. So if you have sufficient inventory, you will avoid the stock out problem. Factors such as seasonality in demand mean that customer purchases do not perfectly match the most efficient production cycle. Those companies who are seasonal in nature, they will produce more in the on season, less in the off season. So they may not follow the efficient production cycle. Every alternate, every choice, every policy involves certain costs. Inventory management also, there is also cost involved in holding the inventory. What are the costs for holding the inventory? Acquisition cost, ordering cost, and carrying cost. So once you buy the inventories must be kept in proper condition. That is, and uh, it must not be spoiling its quality. So you have to properly maintain and hold it and carry it, which is known as carrying cost. So maintaining the inventory in the warehouse is known as carrying cost. Every time you put a new order, you have to spend some money. So that is called ordering cost. Like a purchasing manager is there, he's taking salary, he's calling the supplier, and the supplier is taking some time, making the kind of arrangements. All these are ordering costs. Acquiring the inventory is known as acquisition cost. Buying the inventory, the buying price is known as acquisition cost. So acquisition cost, ordering cost, and carrying costs are the different costs involved for holding the inventory. And the objective should be to minimize the inventory cost without hampering the production cycle. Therefore, you should hold the right quantity of inventory, not more, not less, which we call as the optimum inventory. Not more than that, not less than that. There are many different techniques are there. We discussed in many different chapters. Here we are not discussing the techniques of this holding the inventory, like we have economic ordering quantity, we have just in time, we have Kaizen, many more methods are there. Here we are using discussing the just-in-time method. In just-in-time inventory management, you buy the product when the inventory becomes zero. Simply you made an arrangement in such a way that the inventory will reach you at no time, very quickly. In that case, what happens? You need not hold the inventory for long time in the warehouse. No carrying cost. No minimum ordering cost. Why? Simply you make an arrangement You, for example, you know that whatever inventory you have, it will be finished after 15 days, and you gave a standing instruction to your supplier. He will send you the materials every 15 days. What will happen then? 15th day inventory finished became 0, new inventory came, again another 15 days the same inventory became 0, again new inventory arrived. So you need not, time to time, you need not give new orders, you need not hold inventory for a long time. So your holding cost, your carrying cost, your ordering cost all become minimized, and simply you acquire the cost. The acquisition cost is the only price you have to pay. The ordering cost and carrying cost are minimized. Why? Because you gave a standing instruction to the supplier. Supplier makes arrangement every 15th day. The product comes to your warehouse, store. By that time, the old stock is 0. New stock replenish. Again, the new stock start work for 15 days. Again, the new stock becomes 0, and new replacement will be there, and the cycle will continue. Now we will go to the last section, cash management. What is the motivation of holding cash? Why cash is required? Three different answers come here. Economics says three different uses of cash: transaction purpose, precautionary purpose, compensating purpose. So the cash balance maintained for transactions is transaction balance. The cash required for precautionary need is precautionary balance. The cash required for compensation is required compensating balance. Like, to meet the day-to-day requirement of cash, we have to have some cash in hand. That is called transaction balance of cash. Precautionary, to compensate for the uncertainty associated with the cash flow. Sometime you predicted some cash flow to come, but it did not come. Then how your day-to-day expenditure will run? So keep some extra money as precautionary. Compensating, to satisfy the bank requirements. Every current account needs to be have some minimum amount of money in the bank. That also you have to maintain. So for example, for transaction need, you have to keep 100,000. For precautionary, you need to keep another 50,000, and minimum balance you need to keep in the bank 50,000. That means every time you need to have 200,000 in your bank account for all these three different requirements: transaction, precautionary, and compensation. Alternative investment, because this money, when you are keeping the money in the bank account, it gives you no interest. There is normally zero interest on the current account banks give. Because you are getting no return, therefore you don't prefer to keep more money in the current account. What you do?